I will present a financial analysis of Dutch Lady Milk Industry Berhad using financial ratios and a trend analysis from 2020 to 2024. To begin, financial ratios are an important tool used to evaluate a company's financial health. These ratios are calculated from financial statements like the income statements and balance sheet. They help simplify complex financial data and allow us to assess a company's liquidity, efficiency, profitability, leverage, and overall performance. According to Ross, Westerfield, and Jordan, financial ratios are also useful for investors, creditors, and managers to understand how well a company is using its resources and meeting its obligations. In this assignment, we use trend analysis, which means we look at financial performance over a 5-year period. This helps us identify patterns, improvement, or weaknesses in the company's performance over time. The analysis is divided into 4 main categories of ratios, which mean liquidity ratios, asset management ratios, leverage ratio, and profitability ratios. Each category gives a different perspective. For example, liquidity ratios show whether the company meets its short-term obligations, while profitability ratios show how well the company generates profit from its sales and assets. Next, Dutch Lady Milk Industry Berhad is a well-known company in Malaysia with more than 60 years of history since 1963. It is now part of the Royal Friesland Campina Cooperative. The company produces a wide range of dairy products including milk for toddlers, growing up milk, and nutrition products for adults and seniors. However, Dutch Lady is not only focused on profit. It also emphasizes community well-being and nutrition. For example, the company is involved in initiatives like the National School Milk Program and Sea Nuts Project, which support child nutrition in Malaysia. Dutch Lady also focus on sustainability by using responsible sourcing, supporting farmers, and improving packaging to be more environmentally friendly. Overall, Dutch Lady is a strong example of a company that balances financial performance with social responsibility and long-term sustainability.
Liquidity ratios are used to evaluate a company's ability to meet its short-term financial obligations. This analysis is based on the annual reports of Dutch Lady Milk Industries Berhad from 2020 to 2024. The ratios analyzed include the current ratio, quick ratio, and cash ratio. The first one is current ratio. The current ratio is calculated by dividing current asset by current liabilities. The current ratio measures the company's ability to pay its short-term liabilities using current assets. The ratio increased from 0.89 times in 2020 to 1.58 times in 2021, indicating a stronger liquidity position. However, it decreased to 1.12 times in 2022, 0.8 times in 2023, and slightly improved to 0.84 times in 2024. Overall, the company showed its strongest liquidity performance in 2021, while the ratios below 1.0 in 2023 and 2024 indicate weaker short-term financial strain. The quick ratio is calculated by subtracting inventory from current assets and then dividing the result by current liabilities. The quick ratio measures the company's ability to pay short-term liabilities using liquid assets, excluding inventory. The ratio increased from 0.42 times in 2020 to 1.05 times in 2021, showing strong liquidity. However, it declined to 0.59 times in 2022, 0.32 times in 2023, and slightly increased to 0.37 times in 2024. This indicates that the company became more dependent on inventory after 2021. The cash ratio is calculated by dividing cash and cash equivalents by current liabilities. The cash ratio measures the company's ability to pay current liabilities using only cash and cash equivalents. The ratio increased from 0.17 times in 2020 to 0.39 times in 2021, reflecting better cash management. However, it decreased to 0.24 times in 2022, 0.13 times in 2023, and 0.1 times in 2024. This downward trend suggests a weakening cash position and a lower ability to settle short-term obligations immediately. In conclusion, the liquidity ratio analysis shows that Dutch Lady Milk Industries Berhad had its strongest liquidity position in 2021, as all three liquidity ratios recorded their highest values during the 5-year period. This indicates that the company was better able to meet its short-term obligations and manage its working capital effectively. However, from 2022 to 2024, the current ratio, quick ratio, and cash ratio generally declined, suggesting a weakening liquidity position. The ratios below 1 in recent years indicate that the company's current assets, liquid assets, and cash resources may not be sufficient to fully cover its short-term liabilities. Therefore, the company may need to improve its liquidity management to reduce short-term financial risk and strengthen its ability to meet future obligations.
Today I will explain about the asset management ratio based on the chart from 2020 to 2024. First, look at the average collection period. We are seeing some fluctuation. It improved slightly from 2020 to 2021. It indicates faster collection of receivable. However, in 2022, it increased, meaning the company took longer to collect the payment. Although it improved in 2023, it rise significantly in 2024, about 30 days. This suggests the company is facing difficulties in collecting debts and may have weakened credit control. Next, for the account receivable turnover, the trend is quite similar. It improved in 2021, which show better efficiency. However, it declined in 2022 and recovered in 2023 and then dropped sharply in 2024. This indicates that the company took longer to collect from customers, which reflect weaker collection performance. And moving on the inventory turnover, there is a steady decline throughout the period. It decreased about 4.9 times in 2020 to around 4 times in 2024. This shows that the inventory is moving more slowly, which may suggest weaker demand or excess stocks. While for the total asset turnover, the trend is also decreased every year. It dropped from 2.21 times in 2020 to 1.35 times in 2024. And this means the company is become less efficient in using its asset to generate sales. And lastly, the fixed asset turnover remains stable at first, but then declined sharply from 2020 to onwards. By 2024, it dropped significantly to around 2.33 times and indicating reduced efficiency in utilizing fixed asset to generate revenue. And in conclusion, most of the ratios show downward trends, especially in 2024. This indicate that the company overall efficiency in managing asset and operations has weakened every time, and improvement are needs in areas like receivable collection, inventory management, and also asset utilization.
The debt ratio shows the percentage of company assets that are financed by debt. In 2020, the debt ratio was 63.61%, meaning two-thirds of the company's assets were funded by debt. In 2021, the debt ratio dropped significantly to 45.44%, following a sale and leaseback transaction that reduced liabilities. From 2022 to 2024, the debt ratio stabilized around 50%, with 52.99% in 2022, 43.82% in 2023, and 53.26% in 2024. This indicates that the company has reduced its reliance on debt compared to 2020. The long-term debt ratio measures the proportion of long-term debt to the company's total long-term capital. From 2020 to 2023, long-term debt was very low. In 2020, the ratio was 2.11%. In 2021, it was 1.71%. In 2022, it dropped to 0.52%, which was the lowest during the period. In 2023, it increased slightly to 0.91%. This means the company relied very little on long-term borrowing from 2020 to 2023. However, in 2024, the ratio increased to 12.5% due to new borrowings of 70 million ringgit. Even at 12.5%, this is considered low and healthy. The company's long-term debt position remains very manageable. The cash coverage ratio is similar to the time interest earning ratio, but it adds back depreciation because depreciation is a non-cash expense. This gives a clearer picture of the actual cash available to pay interest. In 2020, the cash coverage ratio was 39.19 times. In 2021, it peaked at 112.66 times due to the sale and leaseback gain. In 2022, the ratio was 26.08 times, which was the lowest during the five-year period. In 2023, it improved to 31.62 times, and in 2024, it further improved to 35.93 times. Even at its lowest point of 26.08 times, the company has very strong cash flow to cover its interest payments. This confirms that company's excellent liquidity position. The equity multiplier shows how much of the company's assets are financed by equity. A value of 1 times means no debt, while higher values indicates more debt. In 2020, the equity multiplier was 2.99 times, meaning for every 1 ringgit of equity, the company had 2.99 ringgit in assets, which indicates significant debt. In 2021, it dropped to 1.83 times, reflecting reduced debt after the sale and leaseback transaction. From 2022 to 2024, the equity multiplier stabilized around 2.1 to 2.2 times, with 2.13 times in 2022, 2.17 times in 2023, and 2.14 times in 2024. This indicates a more balanced capital structure after 2021. The time interest earning ratio measures the company's ability to pay its interest expenses using its operating profits. A safe level is typically above 3 times. The steady I/E ratio is extremely strong throughout the entire period. In 2020, the ratio was 33.46 times. In 2021, it reached a peak of 100.91 times due to a one-time gain from the sale and leaseback transaction. In 2022, the ratio was 70.10 times, which was the lowest during this period. In 2023, it improved to 25 times, and 2024, it further increased to 30.45 times. Even at its lowest point of 70.10 times, the company can still cover its interest expenses 17 times over. This demonstrates very strong financial health. The debt-to-equity ratio measures how much debt the company has compared to the owner's equity. In 2020, the ratio was 1.99 times, which means debt was almost twice the amount of equity. This is considered relatively high. In 2021, the ratio dropped sharply to 0.83 times, meaning equity became higher than debt, which is a positive sign. From 2022 to 2024, The ratio stabilized between 1.1 and 1.2 times, with 1.30 times in 2022, 1.17 times in 2023, and 1.40 times in 2024. Overall, the company's capital structure is much healthier compared to 2020.
Next, I will present the profitability ratios of Dutch Lady from 2020 to 2024. Profitability ratios are used to evaluate the company's ability to generate profits from its sales, assets, and shareholders' equity. In this analysis, we examine 5 ratios, which is gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. So based on the graph, the gross profit margin increased from 32.44% in 2020 to 35.26% in 2021, indicating better production efficiency and cost management. However, it declined to 54% in 2022, which may have been caused by higher raw material and production costs. The ratio then recovered and increased to 33.77% in 2024. Similarly, the operating profit margin increased significantly from 9.09% in 2020 to 25.27% in 2021. This suggests that the company managed its operating expenses effectively. However, the ratio dropped sharply to 4.21% in 2022 before gradually recovering to 9.09% in 2024. For net profit margin, the ratio increased from 6.67% in 2020 to 21.87% in 2021, showing strong growth in profitability. However, it fell to 3.45% in 2022, likely due to increased costs and expenses. The ratio did improve steadily to 6.69% in 2024, indicating a recovery in overall profitability. Moving on to return on assets or ROA, the ratio increased significantly from 14.71% in 2020 to 35.37% in 2021. This indicates that the Dutch lady was highly efficient in using its assets to generate profits. However, the ratio declined to 5.48% in 2022 before gradually improving to 9% in 2024. And lastly, for return on equity or ROE, the ratio increased from 44.04% in 2020 to 64.82% in 2021, showing strong returns for shareholders. However, ROE dropped to 11.66% in 2022 due to lower earnings. The ratio then improved to 19.26% in 2024, reflecting a gradual improvement in profitability and shareholder returns.
So, based on our ratio analysis, we can see that Dutch Lady's financial performance experienced both improvements and challenges throughout the 5-year period. The company performed exceptionally well in 2021, where most of the ratio reached the highest levels. This shows that Dutch Lady was able to generate strong profits and provide high returns to shareholders during that year. However, in performance decline in 2022, as profitability ratios such as net profit margin, ROA, and ROE dropped significantly. This indicates that the company faced difficulties in maintaining its earnings and operational efficiency. Nevertheless, the company managed to recover gradually in 2023 and 2024. Sales continued to increase, reaching approximately 1.45 billion ringgit in 2024, while net profit improved to about 96.6 million ringgit. Profitability ratio also showed positive growth, reflecting better financial performance. Although the liquidity ratios remain relatively low and asset management efficiency weakened over time, Dutch Lady maintained a stable financial structure and was still able to meet its debt obligations comfortably. Therefore, we can conclude that Dutch Lady is a financially stable company with strong recovery capability and positive future growth prospects.